Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. And welcome to your deep dive. We're about to unpack the most important nuggets of knowledge and insight from a collection of recent reports and analyses you've shared with us, everything from leading financial magazines and market news outlets like CNBC, Bloomberg, Reuters, and Yahoo Finance. Our mission, as always, is to help you quickly become truly well-informed on what's driving the global economy and markets right now.
Absolutely. And today we've got some really significant themes to explore. We'll be looking at the ongoing and evolving impact of trade tariffs.
Big topic there.
Definitely. Also, the Federal Reserve's absolutely critical upcoming decisions, some pretty dramatic shifts happening in global supply chains that are, really redefining manufacturing.
Yeah, we're seeing that play out.
And specific corporate insights that offer a valuable window into the broader economic landscape. It's a complex picture for sure, but we'll try to connect the dots and help you see the strategic implications.
Okay, let's dive right into it then. Starting with the immediate market reaction we saw today, Tuesday, July 29th. Asia-Pacific markets are trading mixed. Investors clearly holding their breath, it seems, waiting on those crucial U.S.-China trade talks and, of course, that Federal Reserve meeting later this week. Japan's Nikkei 225 declined by 0.79% today,
Right.
while South Korea's Kospi actually managed to rise 0.66%. So, bit of divergence there.
Yeah, and broadening that view to the U.S. markets, you might have noticed the S&P 500 closed near flat on Monday.
Pretty quiet.
Very quiet. The Nasdaq Composite gained slightly, while the Dow Jones Industrial Average slipped a bit. But what's truly insightful here, I think, is that even with the S&P 500 and Nasdaq hitting recent record highs,
Which as they have been doing.
exactly, that underlying sense of unease, it isn't just noise. It's a crucial signal that investors are questioning the durability of the AI rally and asking if valuations are truly sustainable.
Makes sense.
And this suggests we might not be in like a total euphoria-driven bubble, which ironically could leave more room for the rally to continue.
It's interesting how even CNBC's Jim Cramer weighed in on this. He suggested that while trade deals are certainly happening, investors' primary focus this week is clearly elsewhere.
Yeah, he's pointing to earnings.
Right, earnings reports, the latest unemployment data, and without a doubt, the Fed meeting as the real drivers. He even said, and I quote, "What matters is earnings, unemployment, the Fed meeting, and you know what, dead last? Tariffs."
Dead last.
It makes you wonder if the market has already sort of fully priced in the trade situation or just moved on for now.
That's a great point. And if we connect this to the bigger picture, despite those new record highs, a Goldman Sachs indicator shows that investor positioning in U.S. stocks is still just neutral.
Not exuberant.
Not exuberant, exactly, which suggests there could be more room for the rally to continue without hitting an immediate wall of overenthusiasm. And the Yahoo Finance chart book further supports this. They're showing a V-shaped recovery in S&P 500 earnings revisions breadth.
V-shaped. Wow.
Yeah, rivaling even the sharp COVID rebound in 2020, which, points to pretty strong fundamental support under the surface.
Okay. Now let's pivot to what's been a dominant headline for quite some time. The tariff landscape. President Trump announced a global blanket tariff.
Right, the new baseline.
Likely to fall between 15% and 20% for countries without separate trade agreements. This is significant, especially considering he had previously suggested maybe a 10% baseline. This new rate is expected August 1st.
And what's crucial to understand here is the recently struck U.S.-EU trade deal. While it means a 15% tariff on most EU goods, which is, look, a significant reduction from the previously threatened 30%.
True, it could have been worse.
It could have been much worse. But it's still a substantial increase from the prior, roughly 2.5%, that most EU goods faced. So this isn't a return to pre-tariff days. It's a definitive step into, well, a new trade normal, it seems.
And the European reaction, as you might expect, hasn't been entirely positive. You have EU leaders like German Chancellor Friedrich Merz and French Prime Minister François Bayrou expressing real discontent. Merz said the German economy would suffer significant damage, and Bayrou went as far as to call it a dark day for the alliance, noting what they see as an unbalanced deal.
Yeah, unbalanced is the word they're using.
So the deal might be done, but the sentiment clearly isn't unified over there.
And this raises an important question. What's the tangible economic impact for these European nations? Poland, for instance, estimates a loss of over $2 billion from these tariffs.
That's a big number for Poland.
It is. And the Czech Finance Ministry projects a slowdown in their GDP growth, maybe 0.2 to 0.39 percentage points for the rest of this year and into next. And it's hitting bottom lines directly. Look at Stellantis, the auto giant.
Yep.
They reported a first-half net loss of 2.3 billion euros, directly attributing 300 million euros of its expected 1.5 billion euro full-year tariff impact just to this period.
Wow. So they're already feeling a big chunk of it.
Immediately. And this isn't just about Stellantis' bottom line. It's a stark illustration of how rapidly these new tariffs force major industrial players to reevaluate their entire global production and supply chain strategies. They have to mitigate these direct hits to profitability.
Makes sense. Shifting our focus to Asia, Japan has stated that its U.S. trade deal eases some tariff uncertainties, which is, a relief for them.
Some relief, yeah.
But they acknowledge that risks still remain, especially for its export-reliant economy and its massive auto sector. They're clearly still keeping a close eye on it, not out of the woods yet.
But here's an intriguing observation, maybe a bit counterintuitive. The United Kingdom could be an unexpected winner in all of this.
Oh, how so?
Well, with the EU now facing these 15% tariffs, the UK's existing 10% baseline duty could actually make its exports relatively cheaper for US buyers.
Ah, the differential.
Exactly. That differential might incentivize EU manufacturers, particularly those operating on pretty thin profit margins, to maybe shift some production to the UK to avoid that higher EU tariff. It's a potential strategic advantage that could emerge from this new trade reality.
That's a fascinating wrinkle. But is it truly that simple for a manufacturer to just, pick up and move production across borders like that? What are the real logistical hurdles there?
No, that's precisely the challenge. It's not simple at all. While the UK offers a tariff advantage on paper, these are not trivial shifts. Manufacturers face massive retooling costs, supply chain re-engineering, finding skilled labor.
Right, the whole infrastructure.
The whole 9 yards. It's more likely to be a gradual shift, perhaps. Maybe new investments favoring the UK over the EU for certain product lines rather than an immediate wholesale relocation.
Yeah.
But it highlights the long-term structural changes these tariffs are really driving.
Okay. Despite all this, though, Wall Street seems to be showing what some are calling tariff ennui.
Pure fatigue, yeah.
Yeah, fatigue. Economists, according to CNBC, are actually revising downward their expectations of the tariff's impact on the U.S. economy. Kramer again suggests markets are simply looking past the EU deal, focusing on other catalysts. But isn't there always a risk of underestimating these new normals? Are we maybe too quick to dismiss the ongoing impact?
It's a valid concern. I think while the immediate risk of a, doomsday recession scenario seems to have abated,
Hopefully.
economists still anticipate a period of slow growth and firm inflation. Tariffs have already boosted U.S. consumer prices by about 0.2% cumulatively, according to Goldman Sachs. And they expect these tariffs to push core inflation above 3% over the next year.
Above 3%.
Before eventually declining as the kind of one-time effects drop out of the year-over-year calculation. So the market might be looking past the initial shock, but the economic drag and the inflationary pressure, those are still very much present and will be for some time.
And just to underscore the real-world impact of these policies on smaller players, we saw that specific case with the U.S. Court of International Trade. They declined to reinstate the tariff exemption for low-value de minimis shipments.
Right, the under $800 imports.
Exactly. Imports valued under $800 that used to come in duty-free.
And the impact of this decision on companies like, say, Detroit Axle has been severe. They relied heavily on importing auto parts from China for less than $800 duty-free. Now they're facing tariffs as high as 72.5% on some of these imports.
72%.
Yeah. And this has directly led to facility closures and layoffs for them. It just demonstrates the very tangible individual consequences of these policy shifts on specific businesses and their employees beyond the big macro numbers we talk about.
Definitely brings it home. Okay, let's turn our attention now to central banks and monetary policy, particularly the Federal Reserve meeting, which wraps up Wednesday. Fed funds futures traders are currently pricing in a staggering 97% probability that rates will remain unchanged at 4.25%, 4.5%.
Yeah, it's pretty much baked in.
It seems widely expected to be a non-event in terms of immediate rate changes, right?
Indeed. While no immediate change is expected, analysts are intensely watching for any signals, any hints of a dovish pivot.
The language.
Exactly, the language in the statement, Powell's press conference. A shift towards a more accommodating, lower interest rate stance. This could potentially lead to rate cuts maybe as early as September.
September, okay.
The thinking here is that easing recession fears, maybe a stabilization of these tariff impacts, could give the Fed more flexibility to adjust their stance on inflation, maybe move away from their current, no rush to lower interest rates party line.
And it's hard to ignore the political backdrop here, isn't it? President Trump has been repeatedly lobbying for interest rate cuts.
Very publicly.
Very publicly. Even as Fed Chair Jerome Powell has held steady, citing inflation risks, partly born from the president's own tariff policy. It creates a fascinating tension.
Absolutely. This constant public pressure on the Fed is itself a variable that analysts watch closely because it can influence market expectations, even if not Fed policy directly. And what's also compelling here is how all this ties into the gold angle.
Gold.
Yeah. Fidelity International suggests that gold could hit $4,000 an ounce by the end of next year.
4,000.
That's their call. This projection is driven by, 1, anticipated Fed rate cuts, which typically weaken the dollar, making gold cheaper in other currencies.
Makes sense.
And also by the continued central bank accumulation of gold. They see it as a safe haven asset amidst all this global uncertainty. It suggests a pretty strong bullish outlook for the precious metal, connecting macro policy directly to commodity prices.
Okay. Now, let's transition to a truly significant shift we're seeing in global supply chains. It's been revealed that India has actually overtaken China as the top exporter of smartphones to the U.S.
Yeah, this is huge.
This isn't just a headline. It's a massive structural development, really.
The numbers are quite striking. In the second quarter, 44% of U.S. smartphone imports came from India.
44%.
That's up from just 13% in the same period last year. Huge leap. In contrast, China's share shrank to 25% from 61%.
Oh, what a drop.
And even Vietnam's share was higher than China's at 30%. This shift, it's primarily driven by Apple's accelerated move to India.
Right, diversifying away from China.
Exactly. A direct response to the U.S.-China trade uncertainty and that broader drive for supply chain diversification. However, it's worth noting, while speed is key in this transition, yield rates, the number of good units produced in India and Vietnam, are currently reported to be lower than in China. So there are still efficiencies to be gained.
Interesting trade-off there. Okay, exploring the global AI landscape. China is certainly making moves. The Chinese startup Z.AI, for example, has unveiled its new GLM 4.5 AI model.
Mm-hmm.
What's noteworthy is that it's apparently cheaper and requires fewer NVIDIA chips to operate, despite Z.AI being on the U.S. entity list.
Right, finding ways around it.
Plus, Huawei is making a strong showing with its Ascend AI chips, creating a significant presence at the World AI Conference in Shanghai. So the chip race is very much global, very active.
Which raises an important question. How is Europe responding to this global AI race? They've announced these ambitious plans for gigawatt AI factories.
Gigawatt factory.
Yeah, describing them as a dynamic ecosystem bringing together computing power, data, talent. These are multi-billion euro investments aiming to add 15% to Europe's total computing capacity. They're effectively playing catch-up with the U.S. and China.
That sounds like a massive undertaking.
It is, and there are significant challenges, particularly securing billions more in private investment and overcoming the huge energy consumption hurdles. Each gigafactory could require 1 gigawatt of power.
Which is like a small city's worth.
Exactly, equivalent to a small city. Interestingly, though, U.S. AI chips are still expected to help power these facilities, which highlights the interconnectedness even amid competition.
And not to be outdone, South Korea is also making waves in the AI chip space. The AI chip startup Rebellions has secured significant funding, including from Samsung,
Big backing there.
and is now targeting an IPO. It feels like everyone is trying to find their niche in the AI hardware market, doesn't it?
That's right. And what's particularly compelling about Rebellions is their specific focus. They're concentrating on AI inferencing chips.
Inferencing,
Meaning the chips that are crucial for interpreting live data using pre-trained AI models, think chatbots, image recognition, in real time. Their collaboration with Samsung, which will manufacture their chips using Samsung's cutting-edge 4-nanometer process, positions them as a serious competitor to NVIDIA and AMD, specifically in this inferencing space, which is a rapidly growing segment.
Got it. Okay, beyond the macro trends, individual corporate performance offers crucial micro-level insights into how these broader forces are playing out. Let's look at some recent earnings and strategic moves. Singapore Airlines shares, for instance, plunged over 8%. Yeah, after reporting a 59% drop in first quarter earnings, largely attributed to reduced interest income and losses from its associates. So it seems the airline industry, even with travel rebounding, still faces headwinds beyond just passenger numbers.
Definitely. But in contrast, on the positive side from China, shares of baby product companies jumped. This was after Beijing announced a new childcare subsidy program.
Oh, direct policy impact.
Direct policy impact, offering an annual allowance of 3,600 yuan per child until age 3. This boosted companies like Bingmate and China Fei almost immediately. It demonstrates how government incentives can translate directly to market gains.
Looking ahead, Boeing's Q2 earnings preview is on everyone's radar this week. The company expects a significant jump in revenue and a fall in cash burn. Their stock's already up over 30% year-to-date.
Yeah, it's been a strong performer.
It sounds like a turnaround story might actually be gaining traction there.
Indeed. CEO Kelly Ortberg's turnaround plan seems to be resonating. It involves deliberately slowing and then carefully boosting production of jets like the 737 MAX and 787 Dreamliner, working closely with FAA regulators. It's a measured approach after a really tumultuous period.
Makes sense.
However, we also have to note the recent Air India 787 crash, where pilot error is initially suspected. It's just a reminder of the ongoing complexities and risks inherent in the aerospace industry.
Always something. Turning to consumer brands, Tapestry, the parent company of Coach and Kate Spade, saw its stock climb significantly after dropping its planned acquisition of Capri Holdings.
Yeah, the market liked that move.
Seems like a strong vote of confidence.
Kramer, the Mad Money host, views this as a truly brilliant move. He's positive on this strategic decision, basically saying, focus on strengthening the core Coach brand and maybe exit less successful ventures like Stuart Weitzman.
Right, simplify.
Simplify and focus. He even suggests a potential buying opportunity after Tapestry's August earnings report if expectations aren't fully met, maybe allowing for a lower entry point. It's about strategic focus over just sheer scale.
Interesting take. We also saw some mixed earnings reports from other companies. Cadence Design Systems and Rambus both beat expectations.
We saw tech names there.
Showing strong performance in their niches. However, Nucor, Whirlpool, Western Union, they all missed estimates and provided cautious outlooks.
More cyclical industrial names feeling the pressure.
Exactly. It really feels like a tale of two economies, doesn't it? Some companies thriving, others really struggling with these shifting sands.
Absolutely. It underscores how critical it is for investors to look beyond the headlines and truly understand the micro-level impacts. And what's particularly fascinating right now is this phenomenon we're calling the microstrategy copycats in the crypto market.
Oh yeah. What's up?
Well, a Canadian vape company, CEA Industries, saw its shares surge over 550%.
550%.
After announcing plans to purchase Binance Coin for its corporate treasury. It sort of reflects a broader speculative frenzy, maybe, and a shift in investor interest towards other cryptocurrencies like Ether, moving beyond just Bitcoin for these corporate treasury strategies.
So companies putting crypto on their balance sheet is spreading beyond Bitcoin now.
It seems to be, yeah. Raises interesting questions about market rationality and the broader trend of corporate crypto adoption, for sure.
And on a slightly different note, but one that ties into brand and the economic landscape, the Trump Organization has filed a lawsuit against sellers on Amazon, Walmart, and eBay for allegedly hawking knockoff Trump-branded merchandise, including the infamous Gold T1 smartphone.
Ah, the gold phone.
It seems even presidential branding isn't safe from counterfeits, a truly democratic problem, I suppose.
So if we try to connect all this back to the bigger picture, despite the S&P 500 being at record highs, there's this ongoing debate about historically elevated valuations, right? And the increasingly concentrated nature of the rally.
Meaning just a few stocks are driving it.
Exactly. Market breadth is narrowing. Fewer and fewer stocks are participating in the rally. It raises an important question. How sustainable is this narrow leadership if only a handful of giants are really driving the S&P 500 to new highs?
So what does all this mean for you, our listener, as an investor or just someone trying to stay well-informed in this rapidly changing economic environment?
Well, for one, household balance sheets generally remain pretty strong. That's largely due to rising home prices and surging stock prices over the last couple of years. That provides a solid foundation.
Okay, that's good news.
It is. However, we're also seeing signs that rising living costs are putting financial pressure on some younger consumers, although interestingly, their credit utilization rates appear to have stabilized over the past year and a half. So it's a nuanced picture of consumer health.
And looking at the long-term implications, particularly regarding policy, experts suggest that tighter immigration policies could significantly reduce labor force growth in the U.S.
That makes sense. Fewer workers coming in.
Right. And this could potentially lead to higher inflation even as job growth slows, meaning the economy's real potential GDP growth might be closer to 1% than the typical 2% we're kind of used to thinking about.
Wow, a fundamental shift in our growth potential.
Potentially, yeah.
And this raises an important question for investment strategy. The rise of purely passive investing, just buying the index based on market cap, it presents risks. There's no real price discovery involved. It doesn't really care about valuation.
It just buys more of whatever's biggest.
Exactly. And it increases systemic risk because all stocks are bought or sold simultaneously in these huge flows. So investors might need to think differently about portfolio diversification, maybe looking beyond just U.S. large-cap growth stocks.
To where?
Well, perhaps including international markets more actively, or alternative strategies that can act as more of a shock absorber in volatile environments like the one we seem to be in. It suggests a more active, thoughtful approach might be needed going forward.
That's a powerful thought to end on. If tariffs are indeed becoming a new normal and supply chains are actively restructuring around us, how might this fundamentally reshape consumer behavior and global investment flows in the long run? And, crucially, what opportunities or challenges does that present for your portfolio and your strategic outlook?
Lots to think about. We'll see you all tomorrow morning with new headlines from major financial magazines.